The charts might look bullish to the amateur, green candles, a move up on the day, and people already calling for a new silver bull run. But the order book tells a brutally different story. All right, traders, listen up. This isn't some feel-good price update. This is a wake-up call. Right now, silver, what many call the devilish metal, is trading at exactly 77.63 per ounce in the XAGUSD spot market. Yes, green on the ticker. Yes, price is up on the day. But let's not confuse a short, sharp bounce with strength. Because what you're seeing right now is not a real rally. It is a classic dead cat bounce. A bull trap crafted by forced short covering and algorithmic buying, not genuine buy interest. Price has been hammered relentlessly the past week, and this tiny uptick is simply the market giving back a little air before the next leg lower. And all around the market, the story is the same. A strong US dollar is putting relentless pressure on commodities, especially precious metals. Exchanges have raised margin requirements on silver futures, squeezing weak hands out of the market. Retail traders who piled in near the highs are now nursing losses and are ripe for shakeouts. To the inexperienced, that little green move might feel bullish. You might think, hey, silver's coming back. But let's be honest, your emotions are lying to you. The chart structure above is weak, the volume isn't there to fuel a real breakout, and the order book is thin on real bids. Meanwhile, stops are clustered just below key levels, meaning one big macro print could wipe out today, S-bounce in seconds. This is exactly how the devil ES metal traps traders. It rallies when everyone asks least expecting it. It looks bullish on low time frame charts. And then when the real selling begins, it eats positions alive. So don't get sucked in by a surface move. This isn't a bottom, it's a bull trap, and the market is laughing at anyone who interprets this as strength. All right, we're still sitting at $77.63 per ounce. And if you were feeling tempted to chase this bounce, this is where I need you calm, focused, and emotionally detached. Because now we bring out the smoking gun. Here's the part nobody on social media wants to talk about. While retail traders are buying this bounce to $77, the commercials, the Bullion Banks and major producers, are hitting record short positions. Let me repeat that slowly. While retail is buying this bounce to $77, the commercials are selling into it. That's not theory. That's positioning data. The Commitment of Traders report shows a widening divergence. Managed money increasing longs, commercials increasing shorts. Translation. Smart money is selling to you. They are providing the liquidity for your FOMO. Every time you hit buy at $77.63 thinking you caught the breakout, there's a bank desk happily filling that order on the other side. This is the market maker's game. They push price up just enough to trigger breakout algorithms and retail momentum traders, then distribute into strength. You are not riding the move. You are the exit liquidity. Now let's step outside the chart and look at the real world. Silver is not just a store of value. It's not just a meme metal. It's not just monetary. It's an industrial metal. Electronics, solar panels, manufacturing inputs, automotive components. And here's the problem nobody wants to admit. Global Manufacturing PMI has been weakening. Recession fears in 2026 are rising. Industrial demand is softening. So let me ask the obvious question. Who is going to absorb silver at 77.63 in a slowing global economy? Yes, solar demand is strong structurally. But solar alone is not enough to justify parabolic price extensions if broader manufacturing contracts, if factories slow down, if export demand cools, if credit tightens. Industrial buyers don't chase price higher. They wait. And when industrial buyers step back, silver becomes a speculative playground. That's when volatility explodes. Now look at gold. Gold isn't behaving the same way. The gold-silver ratio is flashing a warning. When silver runs harder than gold without a clear macro catalyst, it often signals overextension, not sustainable strength. Historically, when silver outpaces gold aggressively during uncertain macro conditions, it tends to snap back violently. Gold trades as monetary insurance. Silver trades as both money and industry. If recession risk is real, gold holds up. Silver struggles. Right now, silver at $77.63 is stretched relative to gold's structure. And when that ratio corrects, it's usually silver that takes the hit. This is how the game works. Create volatility, trigger breakout signals, let retail pile in, distribute from commercial hands, pull the rug when liquidity dries up. The charts look bullish to the amateur, but the positioning data tells a completely different story. The order book shows distribution. The KOT shows smart money leaning short. Macro shows weakening industrial demand. The ratio shows overextension. And yet people are celebrating $77.63 like it's the beginning of a supercycle. This is why silver is called the devil's metal. It doesn't just move, it hunts emotion. And right now, emotion's getting loud. So what should you do at $77.63? Simple, nothing aggressive. This is a no-trade zone. Entering a new position right here is not trading, it's gambling. Why? Because the risk-reward ratio is terrible. Upside to $80, roughly $2, $3. Downside, back to 72s, $5, $6. Downside if commercials unload hard, even more. That math does not favor you. Professionals don't trade excitement, they trade asymmetric opportunity. This is not it. If you bought lower, you are in a position of power, but also danger. Let me be blunt. Take 50% profit off the table immediately here at 77. Lock it in. Move your stop to break even on the remaining position. Why? Because if the commercials dump this market and the QOT says they reposition too, you do not want to ride the elevator back down. Markets take the stairs up, they take the elevator down. Protect your equity. If you are holding cash right now, do not chase these green candles. That's how the devil's metal punishes impatience. Instead, wait for a pullback into the 72 Zoer, 73 Zoer support zone. Let price come to you. If it never comes back, you missed a trade. If you buy the top, you lose capital. The choice is yours. One hurts your ego, the other hurts your account. Now let's be professionals. What if I'm wrong? If we get a daily candle close above $80, the bearish thesis is invalid. Period. Above $80 on a daily close, we accept the breakout. We reassess. We adapt. But until that happens, the structure remains. Lower highs, lower lows. This is still distribution until proven otherwise. Your number one job as a trader is not to be right. It is to survive. Capital preservation is rule number one. Opportunities are infinite. Capital is not. Stay disciplined. Trust the data over your emotions, and I'll see you in the next update.